Hi, everyone. Welcome to the Power Hungry Podcast. I'm Robert Bryce. On this podcast, we talk about energy, power, innovation, and politics. And I'm pleased to welcome Adam Rozencwajg. He is a managing partner at Goehring Rozencwajg in New York. Adam, welcome to the Power Hungry Podcast.
Well, thanks so much for having me today.
Now, Adam, I didn't warn you. I warned most of my guests, but I didn't warn you. Guests introduce themselves. I've said you're a managing partner at your firm. If you don't mind, imagine you've arrived somewhere, you don't know anyone, you have 60 seconds. Please introduce yourself.
Sure. So, like you mentioned, my name is Adam Rozencwajg, and I'm a managing partner at Goehring Rozencwajg Associates, and we are a natural resource focused investment firm. So we invest money for our clients. We have a mutual fund for our U.S. clients. We're in the process of having a fund for our international clients as well. And what we do is we really try to do the best and most original research that we can possibly do, and then use that to drive our sort of long-term buy and hold value investment strategies dedicated to the resource markets exclusively. It's all we do. And my partner, Lee's been doing this for about 32 years. I've been doing it for 16 years. And we've been working together since 2007 and independently as Goehring Rozencwajg since 2016. So that's really who we are.
Gotcha. And you're based in New York City.
We are based in New York City.
So, well, you beat me to the punch on this, but so you're long only then. You don't short companies. You're buy and hold. You're buy and hold investors.
That's right. In the past, we've operated a hedge fund. We've had a long short strategy. Since 2016, though, we've been long only. And really, what we had come to notice in the past was that the vast majority of our value add going to our clients was all coming from our long portfolio. And so we said, well, why not offer that in as easy and as low cost a product as possible? And so that's what we did.
Gotcha. Well, so I know that well, let's talk about natural resources. I've been looking at your market commentaries and quite like them. Your latest one was issued November 24th and it was entitled, Why Won't Energy Companies Drill? What's the answer to that question?
Well, it's all about incentives, and that's true. It's probably a blanket answer for anybody, anytime about any topic, but it is all about incentives, and the incentives just really aren't in place today. And what I mean by that is there's really kind of three main pillars to those incentives that are telling the energy companies to basically slow down their drilling activity or grow at a much more measured pace. And instead, all the money that they're making, divert it to returning that capital to shareholders. And the three incentives that we identified, and there's probably some more, but these are the main ones, I think. The first is political. And, you're still seeing a huge amount of rhetoric coming from the administration, both here and throughout Europe, to move away from fossil fuels and hydrocarbons. And so we get asked the question all the time, well, now that there's an energy crisis and now that the government is, aware of this, certainly these things are changing. I said, well, certainly not. There's really no indication that there's been any change in rhetoric or any change in sentiment coming from the administrations at all. And if you look at, all of the responses to the energy crisis, they've all been fairly antagonistic towards the energy companies themselves. And so what I mean by that is, they talked about releasing oil from the SPR to bring prices down. They talked about potentially having an export ban, removing, neither of those would obviously do any benefit to an energy producing company. Talked about removing taxes, gasoline taxes and diesel taxes. Again, the energy company producing the oil and gas doesn't see any advantage to that. The Inflation Reduction Act has huge subsidies for wind, solar, electric vehicles. So nothing there in favor of the oil. So really all the signals that are coming from the administration is still, we don't want fossil fuels and we're going to make life difficult as best we can for the fossil fuel industry. There's been no change there whatsoever. So that's number one. Number two, and this one I think is quite interesting, is investors. And what do I mean by that? Well, in the oil and gas industry has been the best performing sector of the S&P since March of 2020. So you're coming up on 3 years. And yet the multiples of these stocks, the investors' interest in these stocks and the capital coming into this sector has been nil. And I've never really seen anything like that. I've never seen a sector that's had leadership for 3 full years and everyone's just ignored it entirely. When I look at money flowing into the different energy ETFs, they've all seen money flow out over the last 2 to 3 years. I mean, it's really incredible when you think about it. To have that,
despite this bull market,
despite the huge performance, it has not been. Normally, you get prices that go up because you have lots of capital rushing in. That hasn't been the case this time. It's been effectively on liquidation, and the price has still gone up and up and up. It's either been because of short covering, or it has been just on the fact that the marginal price has been set higher and higher. But what it is left with is it's left you with these companies that are trading at fractions of what their inherent intrinsic worth is. So if you're the CEO of an energy company and your company is trading at 5 times earnings and maybe half of its intrinsic value is measured from the cash flows that it'll produce given the oil price, and you have $100 million lying around, and you say, what am I going to spend this on? Your stock price will do better almost 9 times out of 10, 10 times out of 10, if you take that money and you buy back your stock versus put it in the ground, because your stock's cheap. And if you put it in the ground, the market's not going to reward you for it anyway, because they don't really care about production, earnings, or net asset value. So the incentive, even though if you were just had your Harvard Business School cap on and you looked at a single well and you said, should I drill that well? You could generate huge rates of return on a single well, even at today's oil prices. But 9 times out of 10, you're going to be better off buying back your stock. And so that's what we're seeing these companies do. Instead of putting that money in the ground, they continue to buy it back. I've never seen an energy bull market like we have right now that hasn't attracted investor capital. I've never seen a bull market where the industry is not responding. You're still a good 40% below where you were pre-COVID in terms of capital spending in this space, and like 60% below where you were back in 2013, 14, and 15. So we've just...
If I could just interrupt for 1 second, because I think that issue around the buybacks has been something that even the Biden administration says, well, why are you doing that? Why aren't you drilling more? So that investment issue is related back to the capital or to the political aspect here as well, right? That there are 2 interconnected issues there on the politicians criticizing the companies for how they're spending their money.
Yeah, I do think that there's just still a really negative rhetoric coming from everywhere that you look. Whether it's the pundits on TV, whether it's the politicians, there's just a lot of negative rhetoric. There's a lot of feeling that these are going to be stranded assets with no terminal value, that we're going to move away from fossil fuels, and no one has really changed that. I think there is probably an interconnect there where if people started admitting that the challenges to wind and solar, which I know we're going to talk about here a lot, were a threat to the long-term viability of that industry, and that we were going to need, let's say, natural gas for the indefinite future, I would think that would be kind of the cue for investors to maybe start to invest more in the space, get the multiples back up, have capital come in, and that would make the right incentives for the oil and gas companies to potentially actually drill some more. But as of right now, you cannot attract new capital into the industry, and the cash flow that the industry is generating itself, they're not even choosing to keep. They're giving it back. So it's sort of like you have negative capital coming in. You have capital flowing out in the form of dividends and buybacks. And until that stops, you're not really going to fix this problem at all.
So you said there were 3 things. So first, political, and then the investor side. What's the third?
The third is a geological issue, and that's really important too. It's the idea that going back to 2005 to 2010, there was a really pervasive view that we had run out of oil and gas. There's this view of peak oil. Now people talk about peak oil and refer to peak oil demand, but it used to be peak oil was the theories ascribed to King Hubbard as an old shell geologist, and
Sure.
And peak oil supply, and then we brought on the shales, and to put the shales into magnitude, the shale oil fields went from 0 to like 10 million barrels a day crude. That's basically what Saudi Arabia as a country produces today. It took Saudi Arabia 30 years to ramp up to that. We did it in a matter of 4 years. And we also brought on a shale gas industry that when you convert it from BTUs from gas back to oil, it's almost as big as a Saudi Arabia again. So it's like we brought on 2 Saudi Arabias in the same country within 5 years. And so I don't blame anyone for not really studying Hubbard peak oil supply during that period, because it seemed as though we had a huge abundance, and we did. When you look, the numbers really go off a chart. But if you were to back out for a second all the shales, which I'm not suggesting that they're not real or whatever, but if you were to look at conventional non-shale production, all of Hubbard's theories are dead right. Oil supply, conventional oil supply, did peak around 2009, 2010, and it has been in decline ever since. And the same has been true of peak natural gas, and it's been backfilled by this enormous new source, which is the shales. And it was so big that it seemed infinite or endless. But what we actually started to notice is that a lot of the fundamental tenets of peak oil could also be applied to the shales. You take the shales, stand them alone in isolation, and they also follow these big Hubbard curves. And you can look, and some of the early shale gas fields, which were the first ones to be developed, which is the Fayetteville and the Barnett,
Right.
Those have both ramped up, plateaued, and are now in decline. Both are like 60% below their peaks. And we started to look at some of the underlying geological numbers behind when we started to run out of new growth, when we started to plateau, when we started to decline. And it very much follows a Hubbard curve. And so we said, okay, well, where are we then today with the Marcellus, the Haynesville, the Permian, the last shale basins that are still, robustly producing? And we came to the conclusion that, most of those, not all of those, are now squarely in middle life. So they might have a little bit of growth left in them, but not nearly what they were able to grow early on. They're basically in the plateauing period and could decline. So, again, these are kind of like longer term, medium term trends, a year, 2 years. So any given month, you have a lot of noise, and you might get another, million barrels over a couple of years in total. But, the days of growing like 1.5 million, 1.6 million, whatever the peak growth was, those seem to be behind us. And so I think as we now are 3 years into this bull market and the energy price is high, and you're getting some growth, but very, very little out of the Permian. The Marcellus has basically been flat for 6 months. The Haynesville now seems to be pretty flat too. So what does that do to the incentive to drill? Well, I think, if you're an energy CEO and you claim to have kind of like a 10 to 15 year inventory of really good drilling locations left, and you're running a 2-rig program or a 3-rig program, if you add 2 or 3 rigs, now all of a sudden that 10 years is down to 5 years. And all of a sudden in a year from now, your analysts are probably saying, well, what happens, in 2025? And you have to look and think, well, how am I going to transform this company? So given the fact that the politicians aren't giving you any real incentive to drill, and the capital markets aren't giving you any incentive to drill, why on earth would you go and accelerate that depletion and pull that forward to today? It's not like the capital markets, it's not like your stock price is going to rally. If anything, your stock price will probably go down when you announce all this new spending. So I think all those 3 things together means that you've seen a very muted response from the industry, and that's just going to make the problem worse.
And so your thesis, so 6 months ago, I would have said, well, okay, yeah, you're right. So nat gas prices were very high. There was reached $100 roughly per million BTUs in Europe, but now we're having a warm winter in Europe. Henry Hub today is under $4. There are a lot of counter indicators to what you're saying, right? Would you accept that? Is that a fair statement? What I just said?
I think price is the biggest counter indicator right now. I actually don't see a lot of fundamental counter indicators.
Okay.
And that's what's been really kind of interesting in the last couple months. We've seen a big divergence in price. We can talk about oil first, because natural gas, you're right, natural gas inventories could have been worse by now. But you look, for instance, in the US, and natural gas inventories relative to seasonal averages are worse today than they were when the Freeport LNG facility went offline. What it was 8 or 9 months ago, or maybe longer now. So everyone figured that when that facility, that's an export terminal down in Texas,
Sure.
And if it were going to go offline and it caught fire unexpectedly, I guess you can only catch fire unexpectedly,
Sure.
Unless you're an arsonist. Everyone said, well, now inventories are going to build up in the US and be really hurt in Europe. And what actually happened, helped by a little bit of cold weather, but basically fairly average over the whole time, has been that inventories have actually widened their deficit relative to when they started back in or earlier in 2022. So,
So to build on that, if you don't mind me interrupting here, but you're saying that instead of having a bigger increase of gas in storage, it's been very muted.
It has been, yeah. So the market's been quite tight. The U.S. gas market has remained tight despite the fact that the Freeport export terminal has been offline. Europe has had warmer than normal winter, and they really moved heaven and earth to refill their gas inventories. And we had some, and that's depressed prices. But I'm saying, thank goodness they did that. I've had people say to me, well, look at European gas inventories. They're 89, 95, whatever the number was, percent full. And so clearly you guys must have been wrong. I said, well, first of all, the coal burn in Europe is off the charts. It's undone 30 years of green push. Second of all, they closed something like 15% of their industrial capacity. Third of all, they had Russian gas flowing for a good period of that. And fourth of all, they had a really warm winter. So, I mean, I guess it's good. Like, I don't know that it really makes for a bearish gas market, but that helped them out, all of those things. But it just kind of pushes out the real moment of reckoning, I suppose, to 2023. So, look, I think that really the major thing, inventory levels remain quite low in the U.S., both on oil and gas, and globally on oil. They're at 40-year lows, and they show no sign of improving. You have Chinese demand picking up now as they begin to remobilize. The Saudis have come out and said that they don't really have much in the way of spare capacity. The U.S. isn't really growing. So I would say that the only counterpoint to our thesis from 4 or 5 months ago has been the price. And, the price will do what it'll do. The paper oil market and the paper gas market are multiple sizes of the physical underlying market. And I think that there's been a lot of selling, net short selling, frankly, by speculators in that market. So, we'll have to wait and see how the fundamentals resolve. We are of the opinion that over the long term, the fundamentals will always carry the day. But that doesn't mean that traders can't go in and really move markets. And I think that's what we've seen in the last 3 months or so.
So let me just throw a couple things at you here, and I think your analysis. I can't argue with that. I mean, I'm not a markets guy like you are, but I was just downloaded an EIA spreadsheet and about the inflation adjusted price of oil. And last year the average price of crude was about $95. In 1979, again on inflation adjusted basis, was about 89. So you mentioned Hubbert, M. King Hubbert, who came up with Hubbert's Peak in 1952, something like this. Isn't it true that the more oil we find, the more oil we find? But are you saying that these other indicators, the political, the investment, and the geology, have then fundamentally changed those incentives? So there's the incentives to go out and find more oil aren't the same. Am I reading back that? Is that a fair way to think about what you're saying?
Look, I think a major criticism of Hubbert Peak has been that there's always been new technological advances that have helped us either find more oil or increase the available recoverable reserves. And for your listeners and viewers who might not be as familiar, some of Hubbert's theories basically revolve around the fact that there's a relationship between the total recoverable reserves and what a field will produce. And that, I mean, how can you argue with that? If you have more oil in a field, it should produce more oil on a barrels per day basis at a peak than another field that has less oil. I mean, that's kind of stands to reason. And he posited that, in an unconstrained, idealized fashion, you would produce out of that field in what basically looks to be a normal curve, right? So it's kind of like a bell-shaped curve, ramps up, plateaus, and then its fall is basically a mirror image of its ramp up. And there's lots of fields that have followed that. There's fields in Russia, there's fields in the Gulf of Mexico, there's fields in the North Sea, where you see a really clear Hubbert curve. Now, the pushback has always been, well, you have a moving target in your recoverable reserves because what are recoverable today wouldn't have been recoverable 10, 20, 30, 40, 50, however many years ago, because of both technology and then ultimately price as well. So, there's a price element to it also. And there's some truth to that. If you look at a perfectly idealized Hubbert's curve, the right-hand side where that production declines tends to be stretched out a little bit. It tends to be, overshoots the model, produces more than the model would suggest. And the wedge between an idealized curve and that longer curve, we call technology. That's the impacts of technology. So that'll definitely continue to be true.
So to paraphrase there, Adam, so you're saying that technology increases the length of the tail. Is that
It does? Yeah,
Yeah.
it does.
Okay.
It increases the length of the tail. That's a perfect way, simple way of putting it. But what it doesn't really usually do is it doesn't allow for new peaks. It doesn't allow for new periods of growth. Once you're in that decline phase, it might help mitigate declines, but you very rarely see technology come in and have a huge new period of growth. The big exception, of course, is the United States taken as a whole. When you add in the shales and the conventional, then you saw it peak in the 1970s, decline, and then beginning in 2010 have this major second ramp again. And I would argue those are two distinct basins. Those are completely distinct systems. And if you look at each of them in isolation, they each tend to follow a normal Hubbert curve. So what I'm trying to say here, more than anything else, is that these assets that 10 years ago were in their ascendancy and were a nice tailwind to production growth now seem to be at the very least in their plateau period, if not in their outright decline period. And you're going from having had 1.5 million, 1.6 million of growth to almost nothing. That was the only source of non-OPEC oil supply growth from 2005 to 2020. And you're underspending in the industry by nearly $1 trillion. Right. So you're not working with a lot of house money to try to go and bring on ultra deep water, offshore Brazil or what have you. You have a really undercapitalized industry. And I think you take all those things together and it's going to be really tough to see how supply rises to meet the occasion in the next five or 6 years.
Well, I just want to add one quick point there, and I'm sure you know this, but people listening may not know. But the estimates are that in the shale patch in the U.S., that the oil and gas sector, the E&P sector, effectively just burned $300 billion, right? They overdrilled, they spent too much money drilling, they produced a lot of oil and gas to benefit the consumer, but not their own shareholders or their own investors. And so your thesis here in part is that those days are over, that they're not going to do, they've seen that movie, they're not going to, they don't want to see it again.
I think that's right. And I think, one thing I'll say to temper that, or maybe it agrees, I'm not sure, but sure. The oil and gas business is a cyclical business, and eventually this bull market will end, and it'll end with really high oil and gas prices. And this is really important because we did not see it this year in 2022, high oil and gas prices attracting a lot of capital in that brings on a lot of new productive capacity. Now, where that productive capacity is going to come from seems really difficult to try to guess right now, but I promise you, like any cyclical commodity market, this bull market too will end, and it'll end with really high prices, unbelievable enthusiasm, energy probably at 20% to 30% of the S&P. That's usually where they top out, and a lot of new projects being sanctioned. And so then you say to yourself, is that where we are today? Well, no, the only thing we had for 6 or 9 months was high prices. We didn't have any of the others. We didn't have any supply response, no new capital coming in. Energy as a percent of the S&P is still sub 5%. So, we have a long way to go. And there's going to be a huge amount of money to be made for investors, I think, that can look out through this cycle.
So, well, let's put a point on that then. So, are you recommending, obviously, you're long U.S. upstream companies, E&P companies, any ones that in particular that you like, that you care to mention?
This is all publicly available. So we don't tend to talk about stocks all that often, but I'm happy to talk about, what's known that we own and what have you. We own Pioneer, we own Diamondback, we own Laredo. That's probably our most controversial name, but what's interesting is that that's so unloved that it's just so cheap that I think, frankly, it could miss the mark even on people's low expectations, and it would still be a good investment at this point. But what's interesting about Laredo is a couple years ago, they started to make some really interesting acquisitions in the Midland Basin. And again, it was so unloved at the time that no one really realized where they were buying in Midland County. It was actually quite good. It was sort of in a couple little sweet spots because they'd always had this lousy tier 2 acreage that no one cared much about. And when you look at how the company's changed, the quality of that asset's improved quite a bit. And that's when we started to actually buy it, was after that happened. Now, whether that's enough to carry the day or not remains to be seen, but that's probably our most controversial name. It's small. But we have, as I said, Diamondback. Matador is another big one. What's interesting, when I think back, and we were really early shale investors
I'm sorry, Matador, is that Bill Lee's old company? Was that the one that was in Turkey and he was overseas? Is that the same company, or is that, maybe I'm missing? Maybe that's a.
I'd have to go back and look. We became involved with it as a pure Midland, as a pure Delaware Permian player. So, but we were really early shale investors, all the way back in the Fayetteville. We weren't necessarily in the Barnett quite as much, but we were really first movers in the Fayetteville, in the Marcellus, in the Eagleford, and then ultimately in the Permian. And so we have a lot of shale experience. And what's interesting is that for a long period there, in the kind of old days of shale from 2010 to 2016, you really had to determine whether or not these high quality companies were overpriced. And it was this trade-off between quality and price. And you wanted to, for us anyway, we're value investors. You wanted to look at the companies that represented good, deep value and still had high quality tier 1 acres. But since the sell-off, and particularly since COVID, you have a really wonderful market where you can just kind of buy, Pioneer double-digit free cash flow yields. You can buy, super tier 1 companies like Diamondback, and they're trading on 7 times earnings. So you don't have to get too creative these days, I find.
Well, so look, I know enough to get myself in trouble. So you're looking at EBITDA, price to earnings. What are the key metrics that you're really looking at, or if you had 2 or 3, what are those? I know you're looking at the quality of their acreage, but are those on just look for what retail investors would be looking at? What are those numbers that are the real key ones for retail investors to look at?
What I find is actually a really instructive one, is to look. Every U.S. energy company has to disclose what's known as its PV10 value. Mm-hmm. So the SEC requires them to take all their approved reserves, including proved undeveloped, with a 5-year plan that they're expected to be developed inside of 5 years, and run a DCF on those reserves using
discounted cash flow for
a discounted cash flow analysis. Exactly. Yep. So they, the company has to make a model where they look at what every year the cash flows are going to be from the production of the wells, such as they are drilled today and then plan to be drilled in the next 5 years, using actual lifting costs and expected drilling and completion costs. And then you discount those back at a cost of capital, which is set at 10%, which you could argue, is that true or not true? And there's the SEC PV10, which can be found in the 10K, has a lot of limitations, namely a lot of simplifying factors like a 10% cost of capital. However, what's nice about it is that it's apples to apples across every company in the industry. And it's pretty neat. And so as somebody who likes to look at cash flow and free cash flow and discounted cash flows, to have the SEC mandate that these companies do most of the work for you, I think comes in quite handy. So we like to look at the SEC PV10 values at the back of the 10Ks, take out the debt, look at it per share, and how does that compare with the stock price today? And sometimes it'll, the stock price will be above that, and that's okay because those companies will grow, they'll add on new acreage, and they'll develop stuff that was undeveloped prior to that. But that, I think, tends to be a good indicator of value and what we like to look at.
Let's go back to the Permian, if you don't mind, because I live in Austin, and Tulsa's my hometown, so I've been around the oil and gas industry a little bit. By the way, is that any of this in your background? How are you trained? Where did you go to school? What did you get your degree in? I'm just curious.
Philosophy and economics. So maybe.
Okay. But you're also a CFA, chartered financial analyst.
Yeah. And I've spent my entire career in the energy business and the materials business. And I worked for a gentleman who you probably saw crossing behind me here, who's been doing it for 32 years, and it's really his passion and avocation. And so one of the things that I always am really flattered by is when someone in the industry asks if I'm a geologist or an engineer. To me, If someone ever says, "Are you an investor?" I say, "Oh my God, I've done something wrong in that meeting." But if somebody says to
Well,
me, where did you study petroleum geology? That's where I hit my
well,
high marks. So
well, yeah. Well, you talk the lingo. You know
we
that
know
what you're
enough to be
doing.
dangerous.
Yeah. You speak the lingo. So, well, let's talk about the Permian a little bit because I'm in Texas and there were some issues. In fact, I was talking to somebody here in Austin the other day about constraints on, you mentioned Pioneer, other companies that are being constrained on their ability to drill because they don't have enough electricity, right? That there are power shortages in the Permian. One of the things that's driving electricity demand in Texas is this industrial demand, much of it coming out of the Permian, and they don't have enough transmission, they don't have enough generation
Yeah.
capacity. That's a limitation. There's also the issue of water and produced water. If you were going to look at the Permian as a whole, or what are those factors, or could be the other? I mean, you've mentioned these, obviously political, the investors,
Yeah.
the geology, but there are other on the surface issues that could constrain production growth in the Permian. Is
Yeah.
water
There,
water one of them? Electricity availability. What are those other issues that seem to that are clearly looming or already here?
Yeah, I think all of the above, and when you do look at, this is an industry that has been left for dead. This is an industry that has seen, peak to trough, massive, declines on the order of magnitude of 80%, whether you're looking at, rig counts and staffings and things like that. Now it's come back a little bit off the bottom, but you're starting to run into some real problems. A lot of people have left the industry, and I think human capital is a huge issue. We're seeing, steel tubulars and stuff like that are becoming an issue as well. We're seeing some tightness in the frac market and the frac spread market. We're seeing some tightness in, like you said, bottlenecks in water and potentially in electricity. So I think it's going to be a little bit of a game of whack-a-mole, just because this is a really undercapitalized, underloved industry. And so you just have kind of been selling it off for spare parts for the last, in some ways 10 years, but probably at least 5, 6, 7 years. And now as we try to put our foot back on that accelerator and bring production back up, you're going to start to see lots of dislocations. So none of them are impossible to overcome, and I think ultimately will, and what have you. But yeah, you're not in a period of time right now where everything is smooth sailing. You're in a period of time where you have to work against that current. And so what the individual things are is probably less important than just the theme in general, that this is a industry that's kind of been stripped for parts a little bit.
Sure. So let's talk about just oil for a minute, because you recently had your investor meeting in New York on you called the coming decade of shortages. I want to talk about broaden out our discussion into other commodities, including coal, which is something I've been following for a long time. But about oil itself, the issue I've said, if oil didn't exist, I've written this before in one of my books. If oil didn't exist, we'd have to invent it, because this is such a critical commodity for the global economy. Is that part of your overall thesis, that this commodity just simply can't be replaced at scale, then, and therefore people are overlooking that, or they've been hoodwinked or kind of mesmerized by this idea that we're going to switch to something else and we don't need oil? How does that figure into your broader macro look here?
Oh yeah, absolutely. And there's a wonderful set of books for those that are interested by Vaclav Smil writes a lot
Oh,
on
sure.
energy history, and Richard Rhodes does as well. He wrote 2 big volumes on the making of the atomic bomb and the hydrogen bomb, but then he
Sure.
also wrote a history of energy, which I find to be really interesting and fascinating. And you can recast basically all of human history as a search for more and more productive forms of energy. And for a long, long time, almost 2000 years, we used the same form of energy. We used effectively biofuels,
Right.
crops for ourselves and our animals, and wood for our heat and our building materials. And then, what happened was Britain cut down its last tree and it had to move to coal because someone noticed that this lump of rock could burn as well. And it turned out that the energy efficiency of coal, meaning how much energy you get out for every unit you put in to actually harness that energy, was much better, almost twice as good at the time as it was for biofuels. And what's really fascinating is that for 17 centuries, probably longer, but our data only really goes back to around 0 AD. So from 0 to like 1650, 1700, you basically had no growth. The GDP per capita doubled over almost 2000 years. I mean, that's crazy. It's like 0.04% growth. and energy demand was commensurate with that. So you basically had no growth. And that's because all of your energy, so much of your energy was going to just making more energy. And then the rest of the energy that you did have was going towards keeping you alive.
Right.
And moving from wood to coal, the amount of energy needed for energy production's sake, the energy to make the energy itself dropped by about half. And the amount to keep yourself alive didn't change. So you got this little surplus all of a sudden. It's the first time in history you had surplus energy. And it was the first time in history you had surplus capital. Before that, if you wanted to become rich, you had to take it from somebody. You basically had lords and serfs, or you had masters and slaves, or what have you. But when you now begin to develop surplus capital, that began to change, and laws began to change, and the concept of win-win deals started to emerge, because there wasn't such thing as a win-win deal before the advent of coal, as far as I'm concerned. And then you fast forward a couple hundred years, and now you're really humming, and then you come across oil and natural gas, and that's another kind of leap forward. And you go from the period of time of the 19th century to basically 18th and 19th century to what we know today. And you take your biggest city from 1 million people to 22 million people. At any one time, you typically had 1 million person city in the world. Now you have 200 and something, with more every day. Our energy consumption went up 40-fold, and our GDP went up dramatically. Infant mortality dropped to basically zero in developed worlds. So all this happened because of efficient, available, abundant energy. And when you think about how important that's been, and you're now talking about moving the whole system to something new, you would think that a big topic of conversation is, well, what does that new thing look like from an energy efficiency perspective? And It turns out it's not very good at all. When you look at wind and you look at solar and you look at EVs on what we call an energy return on investment, so how much energy you put in to get a unit of energy out, it drops from about 30 to 1, which is what oil and gas is, back down to, at the best estimates, 10 to 1, and at the worst estimates, 2 to 1. And that depends on whether you're in a sunny, windy area or not, and whether you want to account for batteries to smooth out the intermittency, which, of course, if we're going to go all wind or all solar, we're going to need something to smooth it out, because the wind doesn't always blow and the sun doesn't always shine. And I wish we were into more sophisticated discussions, but we are talking about, the fact that the sun sets at night. This should have been kind of dealt with on day one, I would think, but here we are.
Well, let me interrupt you there, because I think this is a really important point that you're making, and it's one that I've thought a lot about, and I've written a fair amount on this issue. But this history that you just recounted, and I'm a big fan of Smill. I have a dozen of his books. I've invited him to come on the podcast, but he's an irascible guy, and he said, "No, no way, no, not going to happen." Right? He's charming in a certain Czech way, but he's press averse.
Yes.
But those points that you're making about the energy being the foundation of society, and yet there seems this kind of glib approach to it, and by this administration, I'll say, and I'm not a Republican, I'm not a Democrat, I'm disgusted, but that there's just kind of glib, we'll switch to something else, we'll just do it, wind and solar. Any thoughts on why we're so, I'm using the papal we here, energy blind or energy ignorant or unaware of this history and the pivotal role that hydrocarbons have played in the progress of humanity? Why are we here at this place, and why are we getting this so wrong?
I think we're a victim of our own success in that regard. And I think, when
we had it too good.
We've had it too good for certainly the last 10 years. And I think that there's been periods of time, I don't know when Smill started writing and when you go back to past energy crisis, but certainly, in the 1970s, you had a dual oil shock from OPEC, and that brought about a lot of sensible thinking about energy. I mean, not entirely, but we changed the way we drive. The size of cars completely changed, and we changed some of our other preferences as well to be more energy efficient. So I think in periods where energy is scarce, you're confronted with these realities. And the flip side is also true. When you have cheap available energy, you don't really have to sharpen your pencil and do such an astute analysis, because you can waste it. And that's what, unfortunately, what we've done. We were given a really great resource in the form of the shales in the US. And instead of utilizing it to bring forward things like, nuclear power, which I think has unbelievably high EROI, very energy efficient. It's off the charts, in fact, and no carbon emitted. And instead of taking the time to do that, what we did is squandered it on something that is very energy intensive, very capital intensive, and ultimately can't solve some of these problems. And so, like, what I like to tell people is if you go back the last 10 years, and I'm saying 2010 to 2020, the decades of the 2010s was really unique in history for two reasons. It had the lowest interest rates in the history of interest rates, so going back 4,000 years, and every major form of energy fell peak to trough 90%. 90%. I mean, that's you basically gave it away. Oil went from 145 to negative, so that was more than 100%. Natural gas went from $15 down to $1.90. Coal fell 90%. Uranium prices went from 142 to 19, basically down 90%. So you gave away energy for free, or 90% off sale, and you gave away capital for free.
So the shale business could afford to waste $300 billion making gas prices free. I mean, that's a joke kind of, but that these confluence of events allowed this shale boom to happen. That great for consumers, terrible for the shareholders. But you're saying that era is over. The cheap capital era is over.
I am saying that era is definitely over. And what I was actually thinking, more than the shale industry, what I was actually thinking was the wind and solar industry, because you develop these huge new projects that are extremely energy intensive and extremely capital intensive. And I don't think that's a major surprise, given that you gave away capital and you gave away energy. I think with the shale industry, look, people talk about how it destroyed a lot of capital, and there's no two ways about it. There's people that were out there chasing, the market was rewarding you for production.
Right.
And so there were companies for sure that went out there and delivered unprofitable production, because that's how they got their stock price up. However, there was a lot of companies out there that were fairly sensible and still grew, where I think they made their big mistake. And so this is kind of a bone of contention I take sometimes, because I don't know if this is quite the same as destroying capital. I don't think any of them, from 2010 to 2014, oil was pretty steady at $100, and then it fell to 40, and it stayed between 40 and 60 for the next 6 years. I don't think many companies had that in their models in 2010 when they were underwriting all this new capacity. And should they have? Hindsight's 2020, sure. But there were some guys that were just out there willing to drill any well that they could get to show growth. But I think the bulk of the industry just got blindsided by that major decline in the price, and it was tragic. And the capital was written off, but I don't know if it's quite the same as it wasn't a proactive decision, I think.
Sure. Well, so let's talk about the interest rates, because I've been watching the offshore wind business, and I'm a longtime critic of the wind business. They don't like me. I don't like them back. It's okay. I'm comfortable with that. But we're seeing already in the offshore wind industry, big projects being canceled, delayed, or they're announcing delays, or they're asking for more, higher tariffs for the electricity they produce. It seems to me this is a combination of high interest rates and higher commodity prices, higher 100%. Labor prices. How do you is that fair? Or how do you read this sudden shipwreck of offshore wind? To really mix use I think the right word here. How do you see it?
No, I think you got it spot on, and we were very early to talking about this. We actually looked, everyone loved to put out these numbers, and it's not just offshore wind, by the way. It's onshore, offshore, solar, and it's also lithium-ion batteries. Everyone loved to talk about this huge progress that the industry has made in all of these technologies, these green technologies, over the last
declining costs, higher capacity factors.
Exactly.
Right, but the material intensity didn't change, right?
No, it didn't. It was all these like learning rates. I said, what's a learning rate? And they said, well, we just get better and better. So what are you getting better at? And they said, making them. I said, how? You're welding steel together. What is it that you're getting better at? And look, there was some improvements, but nothing like what the price would suggest. And the major reason, and we did this model probably 18 months ago, and we wrote about it in our quarterly letter, which is available on our website. We said, how much of the reduction in costs in these different technologies can be attributable to capital costs and commodity prices? and the embedded energy in the commodities in particular, right? So
Right.
the steel price is what the steel price is, but ultimately steel is just energy in a transformed form, right? You dig up iron ore using diesel fuel to run the trucks, and then you run it through a blast furnace by burning coal to get rid of the carbon or the oxygen rather, and make it into steel. So it's just energy in converted forms. So how much of the reduction in the cost of wind, which is a massive steel pylon and a copper laden generator, how much of that decline has been attributable to capital costs and to falling energy prices? It should be very easy to do. It turns out that it is. It takes a week or so of digging through numbers, and we concluded that about 70% of the price declines were attributable to those two factors. Now, why is that so important? Well, because we're still, even going back a year and a half ago, we weren't there yet in terms of where we needed the cost of those things to be in order to really truly compete on an uninterrupted basis. And so you needed that learning curve to continue. And we said, well, not only is the learning curve not going to continue, but we think it's actually going to move the other way. And that was like heresy at the time, particularly on the lithium ion batteries. Lithium ion batteries went from $1,000 a kilowatt hour to 150 a kilowatt hour. And it needed to get to 100 a kilowatt hour in order to really compete.
Right.
And everyone said, well, it did 1,000 to 150. So 150 to 100 should be really easy. And we said, not so fast. 1,000 to 150, the vast majority of that was cheaper capital and cheaper energy. And if you have both of those reverting, you're going to go 150 to 200 to 300. You're going to be off by a factor of 3 from where you need to be. And nobody agreed with us when we wrote that. And that's exactly what's happening now. And so I think that, it's not just limited to that. I think in general, we have brought on 2 Saudi Arabias in the United States in a period of 10 years that took them 40 years to bring on one Saudi Arabia.
Right.
And no one's written the book of what impact that's had on our society. And it's going away now. So I think we have to start thinking, it has impacts on a lot of different things, and it's quite dramatic.
Well, I'll just add, I think, what is GE's renewables business? They're losing $2 billion this year, something like that.
It's really shocking how fast these numbers, these negative profitability numbers stacked up in some of these things. I suspected that they would turn and stop getting cheaper and start getting more expensive, but it's like, the offshore wind in Massachusetts negotiated their tariffs in March and basically said, if we keep this, we'll be bankrupt in November. It's
Right.
like, it's really awfully quick.
A quick station break. My guest is Adam Rozencwajg. He's a managing partner at Goehring and Rozencwajg. It's an investment firm in New York City. You can find him at GoRozen.com, GoRozen.com. Well, we've been talking for about 50 minutes now, Adam, and I appreciate your time. I want to talk about 3 other things, 3 other commodities, because your theme, as you said in your investor meeting in November, the coming decade of shortages. So uranium, coal, and copper. You talk about nuclear in your newsletter in November. You specifically mentioned Poland and its plan to build 3 AP1000s. You said the recognition that nuclear power represents a highly safe source of carbon-free baseload power continues to gather momentum, and that the uranium markets, here I'm quoting, are about to flip from a structural surplus to a structural deficit. A huge uranium bull market looms. So my question is, which countries are going to, a friend of mine, Mark Nelson, has said the nuclear boom is not going to happen in the U.S. because it doesn't have to happen. It does have to happen in Poland. And you mentioned Poland. Western Europe is under much more pressure to get off of natural gas. We have still abundant natural gas here. Is nuclear, here's the question, is nuclear going to, is it going to have to succeed overseas before it succeeds here? How do you see the rollout of this next generation of nuclear plants around the world?
Yeah, it's an interesting question, and I don't think it has to roll out in that way. I think that what you need to start to have happen is you need people to recognize the underlying pros of nuclear power, and cons, I suppose. But I think that the cons are quite limited. Again, if you look at this energy in, energy out, nothing has come close to ever. Nuclear power is off the charts. You had biofuels were 5 to 1, 5 units out for every unit in. Coal got that up to 10 to 1. Hydrocarbons got up to 30 to 1. And nuclear is 100 to 1 on today's nuclear technology, and close to 200 to 1 on the technology that they're advancing now to the end of the decade. And I'm happy to talk all about that because I think we're in a unique position. We know a lot about these small modular reactors that a lot of people talk about. And I was guilty of this too, up until about 9 months ago. A lot of people talked about it, but didn't know anything about it. And I was the same, I'd read what I read in the paper, but we spent the last year or so really getting familiar with these technologies, visiting with them, talking with them. Most of them are private companies, and there's some really interesting things that are being worked on that have when I say near term, end of the decade applicability.
Well, can we follow up on that, because I'm fascinated by these as well, and we've had NuScale went public. Their ticker's SMR. X Energy just announced they're going to go public this year. Any of those companies you think are more promising than another? I mean, I'm kind of inclined toward the gas cooled reactor because of higher enthalpic efficiency. There are a number of other things. But NuScale has the advantage of being light water and potentially getting regulatory approval more quickly. Any ideas on handicapping who might prevail in the SMR market?
Well, I think that one of the things that will obviously be tricky for all the SMR guys is going to be the Nuclear Regulatory Commission. So I put that out there we haven't approved a new nuclear reactor design in many, many decades, frankly. And certainly nothing as fundamentally different as what we're talking about with some of these technologies ever. And so, there's a little bit that is sort of out of your control because it'll depend on the regulatory commission approving these new designs.
Sure.
The one that I would say, that we're think is the most intriguing is none of the ones you talked to. The private company is TerraPower, which is the Bill Gates backed venture, and they're doing a molten salt fast reactor. So that'll use what they call high assay, low enriched uranium. And they just announced that there's a slippage in their timeline for that project because they were expecting to source some of that HALEU from Russia. They're the only people that can make it right now. Shouldn't be difficult to make. That's what everyone's always said. You just continue to enrich it until you enrich it a little bit more. But we've never had the need for it. And so we don't have the facilities here. And so with Russia as a backstop now gone, they've moved their timelines out. But what they're looking to do there has the major advantage of being low pressure. And so you don't have, these hundreds of atmospheres of pressure that you have with light water reactors and heavy water reactors, pressurized water reactors. And because of that, your steel goes down, your cement goes down, your size goes down, everything goes down. And because you're dealing with high assay, low enriched uranium, your waste stream goes down quite a bit as well. So that tends to be really interesting. I think NuScale, their benefit is that they're doing the least new things, and so should be the easiest to get permitted. Their downside is that they're doing the least new things, and so has the least amount of benefit over an AP1000. It's just really what NuScale's claimed benefit is more than anything else is that it's smaller, and instead of building it on site, they'll build it in a fab plant, and they think that that'll drive costs a lot lower. Now, I'm sure that assembling a nuclear reactor in the field versus in a facility where everything's temperature controlled is more expensive to do in the field. Whether that's enough to carry the day over a decade of permitting is anyone's guess.
But the bottom line here, I mean, in terms of commodities, is that you think this is all very bullish for uranium.
I do. And I think that the sentiment is starting to change towards uranium. And so I think, the idea, all of these facts that I've just told you about were true 5 years ago, but you never would have been able to push this 5 years ago. I mean, just never. It just was a non-starter in the United States or anywhere in Europe, anywhere outside of China.
But the landscape changed after
it has. And so now I think if people are favorably predisposed to the technology and they're willing to look at it with a fair approach, and they're willing to look at the waste issue, which is entirely manageable, the safety issue, which nuclear has the best safety record out of any source of energy by far, and people are willing to have an open mind on that, then the US should adopt it for its merits alone, even if it has a lot of natural gas. So the sentiment is shifting, and now it's anyone's guess. So I don't think it has to be Europe that moves first. I think maybe pragmatically it might end up being that way. We're seeing activity already. We're seeing France recommit to its nuclear program. England is going to have a big build. Belgium just announced that they're going to extend their lives. China continues as the juggernaut in terms of new reactor builds. India's taking an active role now, and Saudi will as well. So there's a lot going on in an area that was awfully dead, as recently as 2 years ago. And we actually made our investments at the end of 2018, and the idea there was not based on any type of a nuclear renaissance in the West. It was just based on the idea that Cameco and Kazatomprom prices got so low for so long. You had a duopoly that couldn't sell product above its cash cost to produce. I mean, a monopoly is supposed to have like all this pricing power or whatever. You had a monopoly or duopoly that couldn't even have a positive margin. I mean, I've never heard of that. And so you had China, which was chugging along, and you had no new mine sanctioned in like 20 years. And so we said, well, this is going to become a bull market at some point. And then this major nuclear renaissance in the West is just a huge tailwind.
So which countries are going to be the ones that then get to capture that uranium market then? Will it be Canada, Kazakhstan? Where do you think that this, I'm not bullish on mining in the U.S. because of all the permitting issues, but which countries are going to be the ones that fill that uranium, that need for this new uranium production?
I think probably the low hanging fruit is Canada. There's projects in the Athabasca that, pardon me, that will likely move ahead. They've been on the drawing board for some time. There hasn't been any capital or interest or the right uranium price to incentivize that. And I think that's all starting to change now. So that's probably the first things to move. I think you might actually have some in situ projects that work in the US, because I think there'll be a little bit of a concern for, security of supply and supply chain and all that, whether or not Canada gets counted as America. I'm Canadian by birth. I lived there, grew up there. I know there's a very special relationship between the two countries, but I think Canada probably is first, in the United States. And Kazakhstan, from an asset, the Kazakh asset is phenomenal. From a governance perspective, it's been quite good. Everyone's just always been like, oh, Kazakhstan, but they privatized some mining assets before this one, and then they privatized Kazatomprom, and we own that. We own the Canadian players as well. So I think there'll be room to go around.
Well, so last two commodities then. And Adam, my guest again is Adam Rozencwajg. He's a managing partner at Goehring and Rozencwajg in New York City. They're at GoRozen.com. Coal. I've been following the coal market. I've been writing about it for a dozen years. People write it off, and yet coal demand continues to rise. I was just looking at tradingeconomics.com. The price now is still the Newcastle benchmark is $380. It's roughly 8x what it was in mid 2020. Handicap that market. Compared to oil and gas, this has been far greater increase in price on a multiple than any of the other commodities we've talked about so far. Are you bullish on coal?
Yeah, so I think short term and medium term we are. I think longer term we're a little bit more cautious, and we can talk about why. We went into this bull market, unfortunately. In the past we've had huge coal exposure. In the past, we were probably the largest coal investors in the world in the last cycle when we were at Chilton. Basically we're out of that market for most of the last decade. Decided to get back in about a year ago, a little bit too little, a little bit too late. Well, not too late, but wish we'd done it sooner. A funny fact, going back 125 years, every commodity bull market, over every commodity bull market, the best performing, not necessarily from beginning to end, but a period in the middle, the best performing sector has always been coal, always, in every commodity bull market. And so the big question was it going to be this time as well, or was this time really going to be different? And of course, this time is never different. And it looks like coal will probably be the best performing asset class this time as well. Why are we cautious sort of long term? Well, I think the reason why we're cautious long term is if you kind of think about a matrix of what you want in an energy source, you want it to be really efficient, so high EROI, and really low carbon intensity, really low, CO2 per unit of energy output. And what you often get is trying to trade off units of efficiency for units of carbon intensity. And that, we can debate that as long as you want. But clearly, if there's something in the quadrant that is really efficient and low carbon, you should go for it. And if you have really, really high carbon and low efficiency, you should stay away from it. Unfortunately, we're doing exactly the opposite, right? High efficiency, low carbon is uranium, and we've stayed away from that. Right. Low efficiency, high carbon is cutting down trees and putting them into wood pellets. We've been embracing that. But the reason why we're a little bit cautious of coal long term is that you have natural gas is just as efficient as coal, and it has half the CO2 per unit of output. So I
Right.
think that long term coal is a shrinking slice of a growing pie. So does that mean you can't have years of growth? You absolutely can, but gas should be a growing slice of a growing pie. So we would prefer gas to coal. But I think right now that kind of misses the point. You have a whole continent that's scrambling to deal with their energy security issues because there's not enough gas.
Sure.
And so to sit there and pontificate and say, well, I really think that coal's going away because we need more gas.
What they
I mean,
should be doing is going to be different from what they actually are
that's
doing.
more my philosophy degree would come out if I were to do that.
I would, well, I coined credit to my friend Roger Pilkey Jr., the iron law of electricity. Countries, people, and individual and business are going to do whatever they have to do to get the electricity they need, and the coal market proves that. Okay, so last commodity then, and then I'll have two last questions for you, Adam. What about copper? I had a recent guest on the podcast, Simon Michaud, who's done this amazing work for the Finnish Geological Survey, talking about mining and minerals and demand for copper and the energy transition and so on. You said the next leg. Here, I'll quote from your recent newsletter. In fact, I think it's the November one. We expect copper prices to surge in 2023 as copper traders finally realize inventories can no longer fill the gap between demand and supply. The next leg of the copper bull market is about to start. So you're long copper. Which countries will be the ones that are going to meet that copper demand? And any names and any companies that you like there?
Well, look, I think that's the really big question mark, right? Is that copper has this long lead time. It has like a 10-year lead time from discovery to mine production. And there's a real hole right now. So on the supply side, things look awfully, awfully tight. Kamoa-Kakula, which is the big DRC project that Ivanhoe brought online, that was the last kind of really big project to come on, and it did. It's ramping up now, so you'll get some expansion capacity there. The Cobre Panama, which is First Quantum's project, that's now dealing with huge government issues, and it's basically being put on temporary care and maintenance. That'd be a massive, massive blow to the copper supply story. And Chile in general is becoming now a huge problem with both water issues and labor unrest across the country. So the supply side seems pretty brutal. Looking forward, where's the next major source of new copper going to come from? I mean, I think you look at some of the articles that get written on Bloomberg, and I think that goes to show you just how tight things are. One was like a whole new technology that could be used to leach copper out of what would be previously unrecoverable sources. When you start talking about that, that means that you don't have a lot of good undeveloped deposits waiting in the wings.
Right.
Robert Friedland is started this Ivanhoe Electric, which we own, as full disclosure. And that's bought assets in or vended in assets in the U.S., which he thinks have been previously undiscovered because he has this new imaging technology that he uses that can help unlock some of these harder to find deposits. Maybe it's in our own backyard, who knows? And then just this morning they announced what I think could be the most exciting long-term prospect for undeveloped and undiscovered copper deposits, which is Saudi Arabia of all places. And so here we're recording this on the 11th, and that was announced at the Future Minerals Forum, which is the second annual Saudi mining conference. We went to the first inaugural one last year. We didn't go back this year just because our schedules didn't allow for it. But what's interesting is that, Saudi has very prospective geology for hard rock mining, but it's never been explored because obviously they've devoted all their time and attention to their energy business.
Right.
So now it's been, they're calling it this Vision 2030, where they're going to add these different legs to the stool of the Saudi economy, not just be all energy. Tourism is one they want to push. High tech is one, but mining is a really big one. And so Ivanhoe Electric.
And that announcement, just to be clear, that wasn't Ivanhoe's announcement. You're saying this was the Saudi government.
No, it was actually Ivanhoe. So Ivanhoe,
okay.
Ivanhoe Electric, not Ivanhoe Mines, Ivanhoe Electric announced this morning that they would enter into a joint venture with the state-owned Saudi mining company to prospect on a big land package in the country.
I see. Interesting. So, last a couple things then here, and Adam, you've been kind with your time. I ask these my guests introduce themselves, and I ask them, "What are you reading? What any books on the top of your list? Do you have time to read books? What is what are you what's on the top of your list?"
Yeah, so I'm finishing up the second volume of Richard Rhodes's atomic bomb, or this is the hydrogen bombs, dark sun or dark sky, I can't dark
Uh-huh.
sun. And that's quite good. It's a big one, so it's taken me a little while. I just started Robert Kennedy's book on the Adriatic, which is pretty interesting. It's a history, of the Adriatic Sea, and its role as basically the intersection of the East, not the Far East, but the Orthodox East, and the Catholic West, through Europe. That's pretty interesting, more on the history side of things. And then the
And
next,
what's do you remember that title? And
it's
the
called
author is,
Adriatic.
and the author is Robert Kennedy.
That's right.
Okay.
Yep. And then the next thing I want to read after that is this blanking on the author, but the myth of American inequality, which is an interesting economic study that shows that once you get out of the top, whatever, I'll probably get the numbers wrong, but the top 5% of American income earners, and you factor in transfer payments, everyone else, the other 95% of the country, all makes the same amount of money net of transfer payments. And so this idea of massive American inequality, it's just the opposite, and that's led to some of the distortions that we see today.
So, last question: what gives you hope?
Well, I'm actually, through this whole energy crisis, I've become incredibly optimistic and I've become incredibly hopeful. And I think that it's nuclear power that really gives me hope, because when you look back over the entire history of humanity, I've really come to believe through all my reading and research that of all things, you'll die, but moving from wood to coal has been the most important event of the last, 2000 years. And it unleashed all this surplus energy, all this surplus capital. In my mind, it's part and parcel with a lot of the societal changes that occurred in the 17th century. And
Sure.
it really formed the world we know today. And it's because we moved from a less efficient to a more efficient source of energy. And if we can do that again, then I think perhaps the next 10 to 15 years could be as monumental as the early part of the 17th century was, and usher in a huge new period of prosperity. So I've gone from being really pessimistic and saying, oh my God, it's all over, to becoming incredibly optimistic if we can get this right.
I like that a lot. I'm adamantly pro-nuclear, have been for a long time. And as in my view, you don't have to be you don't have to think about climate change. It doesn't even have to be part of the discussion. If you're serious about sparing land, reducing mineral and metal inputs, nuclear is the way to go. And so I think I really like the way you phrased that. Well, my guest again has been Adam Rozencwajg. He's a managing partner at Goehring Rozencwajg. They're doing some of the best analysis on energy return on energy invested that I've read anywhere. You can find more about their work at goerozen.com. Adam, thanks a million for your time. It's really been great fun.
Thank you so much. Enjoyed it.
And all you out there in podcast land, tune in for the next episode of the Power Hungry Podcast. If you want more of my stuff, check out my Substack, robertbryce.substack.com. Okay. All right. Until then, see you.